Hey everybody, today we're going to finish our discussion about the financial system by looking at the money market and the loanable funds market. And we're going to look at how to draw these graphs, as well as look at some of the factors that cause changes in both supply and demand in both those markets. And at the end, we'll sort of see how these two work together to determine interest rates in the market. The money market is drawn, the graph is drawn with a vertical axis being the interest rate, the nominal interest rate. And the horizontal axis is the quantity of money, either demanded in the economy or being supplied in the economy. The demand for money is downward sloping, and it's based on opportunity cost. If I carry cash, I'm giving up whatever interest I could earn by having that money in a checking account or a short-term CD. And so the higher the interest rate I could earn on my money, the less money I want to hold now, and the lower the interest rate I could receive on my money, the more I'm willing to carry because I'm losing less, right? If the interest rate is 0.01%, then it doesn't really matter if I keep it in the bank or I keep it in my pocket. I'm not losing very much. If the interest rate was 8%, that would be different. If I'm giving up 8% return by leaving money in a checking account, then I'm less inclined to want access to money in order to purchase things. So as interest rates rise, the quantity of money demanded begins to shrink. As interest rates drop, the quantity demanded of money increases. So it's a downward sloping relationship. The supply of money, the money supply, is fixed by the Federal Reserve. The Federal Reserve has a goal for what it thinks money supply should be, and it's using its three tools that we talked about in a previous lesson to keep the money supply at a certain point. And so money supply is, because it's fixed, it's a vertical line. Now, the Federal Reserve can increase or decrease the money supply in order to get the market to be at a specified interest rate that it wants, but that money supply itself is going to be set, and the amount of interest in the market is irrelevant to how much money supply is being produced by the Federal Reserve. The money market equilibrium then is where supply and demand intersect. And so where the money supply and money demand intersect, that will be the market interest rate. We're going to call that the federal funds rate. Now, one thing too, just sort of a side note on this graph, sometimes you'll see the money demand curve drawn as a straight line, like you saw on a previous slide. Sometimes you see it drawn sort of as a swooshy curve, like you see on this graph. It doesn't really matter how you draw it, okay? Sometimes people get hung up on, should this one be curvy or straight? It doesn't matter. What matters is it's downward sloping. So however you want to draw the graph, it does not matter as long as it's downward sloping. I will say that sort of experience shows it's much easier and you get into less trouble when you draw a straight line downward sloping demand curve. It makes the analysis a little bit easier, but however you want to draw it, you draw it whatever makes you happy. Okay, the key here is that where they intersect, that's going to be the market interest rate. And that market interest rate will change depending on if there's a shift either in the money supply or in the money demand. So what's going to cause demand to shift? Demand might shift for money based on a change in aggregate price level. If prices are rising, then we need more money to buy the same amount of goods. So when aggregate prices are rising, there is a shift in money demand to the right. People will demand more money, regardless of interest rate, when things are more expensive. Changes in real GDP also influence the amount of money that's demanded in the economy. If GDP is increasing, then presumably consumption is increasing, or business investment is increasing, or government spending is increasing. All of that requires money. And so there is an increase in the demand for cash when GDP is increasing, and we'll see a shift to the right in the money demand curve with a growing or expanding economy. Money supply is going to shift based on the Federal Reserve's desire for a particular interest rate. And so the open market committee is the primary tool, is the buying and selling of T-bills. We'll try and adjust the money supply to achieve a market rate that the Federal Reserve believes is optimal for the economic growth they want to see. If they wanted to reduce the interest rate, then the Federal Reserve would have to increase the money supply in order to bring that equilibrium point down to a lower interest rate. And as you may recall from a previous lesson, if the Federal Reserve wants to increase the money supply, then they're going to have to put money into the hands of banks. And that means buying T-bills off of banks and exchanging cash for those bills. The loanable funds market is looking at the supply and demand of loans in the economy. And for the sake of our conversation and for ease of our analysis, we're going to pretend that there is a singular loanable funds market. This is not realistic. In the real world, there's a market for car loans, there's a market for student loans, there's a market for home loans. We're going to just slam all those together into one market for ease of analysis. The loanable funds market is also set up with a vertical axis of interest rate. This is going to be the real interest rate, or R. And the horizontal axis is going to be the quantity of loanable funds. And the real interest rate, the equilibrium interest rate, will be determined based on supply and demand. The demand for loanable funds is based on a rate of return. That is, if businesses think they can earn more money than it costs to borrow, they'll want more loanable funds. The quantity of loanable funds will increase. And if they think that it's going to be more difficult to earn money relative to the price that they have to pay for it, then the quantity of loanable funds will decrease. So if the interest rate is 12% to borrow, if the loan rate is 12%, then only some investments by businesses, for example, are going to earn at least 12% rate of return, and therefore very few projects are worth borrowing money for at a 12% interest rate, and so less loanable funds are needed. And then, but if the interest rate was 4%, then an increasing number of investments become profitable. Anything that earned between 12% and 4% rate of return become profitable when the interest rate drops to 4%, and therefore there'll be an increase in the amount of loanable funds needed. And that's why we're seeing, again, a downward sloping relationship for demand of loanable funds. The supply of loanable funds is upward sloping. It represents foregone consumption. You have to decide, are you going to put your money into the bank, in which case they can lend it to other people, or are you going to use it for yourself? And how much money people are willing to pay you in interest for access to your cash influences how much you're willing to leave in the bank and how much you want to put towards your own purposes. If lending money to somebody gets you a 12% rate of return, then you are very happy to forego purchasing other things with your money and give it to somebody else. But if they're only going to pay you 1% or 2% in interest, then maybe you'd rather keep your money to yourself and spend it for your own needs rather than let somebody else use it instead. And so you do see this upward sloping relationship when it comes to the supply of loanable funds, because the more you're willing to pay somebody, the more they're willing to let you borrow from them. We put supply and demand together where they intersect. That will be the real interest rate within the market. And that's where we find equilibrium. If the price of lending, if the interest rate was higher than 8%, if it were 12%, we would have a surplus of funds in the market. People would be willing to lend it out, but fewer people are willing to borrow because the cost of borrowing is higher. And so in that case, we would begin to see the interest rate begin to drop. If the interest rate was lower than 8% for some reason, if loans were going out at 4%, then we would see a shortage of loanable funds. There'd be a lot of people willing to borrow at 4%, but very few people, or certainly fewer people, willing to lend at 4%. And so we would begin to see the price begin to rise till we got to that equilibrium point. demand for loans is going to shift primarily because either business opportunities are changing or because the government is borrowing. If we think business opportunities are going to increase, we think happy times are ahead, we think the economy is going to begin to grow soon, we would see a right shift in the demand for loanable funds from businesses who want to get out ahead of that in order to take advantage of the increasing consumption that goes with a growing economy. Or we could see the government needs to borrow more money for whatever reason. They want to spend money on infrastructure, or they want to fund the Defense Department to protect the country from invasion or something like that, right? Anytime the government needs to borrow more than it did before, you're seeing a right shift in the demand for loanable funds. And if for some reason the government wants to borrow less, or if companies think that the economy is going to shrink in the future, we might see a left shift in the demand, which is going to cause a reduction in the interest rate for loanable funds. When it comes to supply of loanable funds, think about this in terms of putting money into the bank. The supply of loanable funds will change if there's a change in the amount of savings that people are putting into the bank, or if there are a change in capital inflows from other countries. If people save more, or there's money coming into our country from foreign investors, we'll see an increase in the supply of loanable funds. There will be more dollars available to lend than there were before, regardless of interest rate. If that's the case, we'll see interest rates drop. If people save less, or if money is flowing out of our country and into other countries' banking systems, we have what's called capital outflows, then we would see the supply of loanable funds shrinking, and that's going to cause the interest rate to rise. So now let's try and put all of this together and see how these sort of relate to each other. In the short run, we'll see that a change in money supply changes interest rates. If, for example, the Federal Reserve chose to increase money supply, shifting it to the right, we would see the interest rate go from R1 down to R2, that new intersection point between money supply and money demanded. Because there's more money in the money supply, there is more money in banks, which means there's more money available to loan out to people, businesses, government, what have you. So the supply in the loanable funds market, the supply of money available to be lent, is also increasing. And so we will see a drop in the interest rate in the loanable funds market as well. In the long run, however, we see that a change in money supply will have no long-term effect on interest rates. Why? Well, if we're increasing loans, if we're increasing business investment, if we're increasing consumption, then we should see an increase in real GDP. We should see an increase in our ADAS model. And when that happens, we see aggregate demand shifting to the right. We'll see an increase in price level. When price levels increase, everything's more expensive. There's inflation, which means everyone needs more money to buy the same amount of goods. The result then is an increase in the demand for money, a right shift in the money demand curve, causing interest rates to now rise back up towards the original R1. This increase in the demand for money also influences the amount of money available to be lent by the banks. If people need access to more cash than before, that means there will be less savings in the banking system, less money available, therefore, to be lent to businesses and governments. That's going to cause the supply, long-term supply of loanable funds to decrease or shift to the left. And as it shifts to the left, we'll see an increase in the interest rate back up towards the original level of R1. So short term, there is a change in interest rates. Long term, the economy begins to readjust itself, and we see sort of no long-term impact on interest rates. We'll talk more about this in class. We'll work on some problems together, and I will see you then.